Data Kinetics. So this one's probably not that relevant anymore. You know, I say moderate to high. But what happened here is, back in the 90s, right before the taxable supplier rules came out, is just to show you the kind of theory of what's a Canadian expense physically in Canada and what's a foreign expense. Is that we had a company who rented a mainframe computer down in Alabama and paid roughly $280,000 in expenses during the year to use that computer, which they claimed all as an SR&ED cost. CRA denied it, saying it's a foreign expense, it's not in Canada. And the client successfully argued, no, it's a Canadian expense because the researcher who was telling the computer what to do was sitting in Ottawa. And the fact that the computer's wherever is irrelevant. The research is being done by the researcher, not by the computer. And that's what the judge looked at. He said, where's the research being done? Is it the researcher telling the computer what to do that's the research, or is it the actual computer calculating the things that's the research? And he believed there was the researcher telling the computer. Where the actual calculations happened, he said, was irrelevant. If the research was conducted in Ottawa, all of the costs were supporting activity, client won. Now I'm saying it doesn't work anymore because in the late 90s they brought another rule in saying that the payment has to be to a taxable supplier, i.e. someone who invoices you with an HST number. So by definition, payments to a foreign source guy for doing work in their country is not going to create that basis of eligibility. But like I say, an interesting one just to look at the principles on how the courts apply the logic. Foreign expenses in general. One of the changes that we saw recently in the last 4 to 5 years is that the law used to say, and be applied in many cases, that if a Canadian employee went outside of Canada, even if they're doing SR&D, you don't get to claim those costs. Right? And then I wrote letters to 4 different ministers of finance over the past 12 to 13 years, explaining why that was such a bad idea, how our federal science policy has 3 objectives, and one of the main ones is we have to encourage our scientific community to leverage knowledge from abroad, to travel and leverage knowledge from abroad. And I'm saying restricting the guy from doing SR&D abroad is actually contrary to that objective. Our tax policy completely contradicts and conflicts with our science policy. It's a disincentive. I said what's even worse is that when that individual files their personal income tax return at the end of the year, they don't say, oh, by the way, I was in Germany or California for 3 weeks, so I'm not paying any income tax on that. No way. Every dollar they earn, the tax still goes to Heron Road in Ottawa. Canada got all the money for all the work they did in Germany, for all the work they did. Canada got all that money. 46 cents on the dollar, let's say, if you're in top marginal rate. So why not kick back 20 cents on the dollar to the SR&D company who's bringing back the knowledge that's completely in line with the legislation that we want? And finally, I mean, I had to argue through everyone. At every level, they said, that kind of does make sense, you know? But we can't go 100%, so what they'll say is, you can have up to 10% of your time abroad and foreign, up to 5 weeks a year is what they used. We'll allow you up to 5 weeks a year because someone came up with a good rule of thumb is a good engineer probably has to spend a month to a month and a half abroad to stay current, or a good scientist in their practice, but not much more than that. I don't know. So now the rules say up to 10%, you can have that. That's cool as long as the employee's paying, you know, salary and wages in Canada and the government's getting all their tax. For practical purposes, I've always ignored this rule. And most CRA reviewers, because they agree, the senior ones, with the way I think on this and the basis of it, will tell you things like, listen, if you do a proxy election and you don't flag foreign travel expenses, and your research just talks about your ideas and why you use this hypothesis versus another, and doesn't say you were down in Chicago at the time, I don't care. As long as your T4 wages that you paid are in line with what we're doing, I'm going to give you the credits. So administratively, most CRA reviewers have kind of gone the way saying, if you don't flag us to something, we want to let this go because we agree that's the right way to do it, independent of what the CRA says. So again, an area of a lot of confusion. And the rationale on why you do something is just starting to hit the people in Ottawa. They're starting to understand, why are we doing something? Why does Quebec pay everything on wages, 40% refund on wages, and nothing on materials? Because Quebec totally gets it. That's what keeps high tech employment in there, and that's really what encourages the SR&D, way more than any of the other measures. Oh, ASA. So here's a company called Quantetics. This actually So to close off on this, to show you how ridiculous they apply these rules, there's a company in BC called LGL, and they're doing environmental research to help save the whales. And what they have to do is they have to follow these whales around to determine their migration patterns and all kinds of other stuff. So the first question is, what's the definition of Canada, which at the time was the territorial sea? This goes into a whole bunch of other kind of interesting things. 24 nautical miles. And since this case, it's actually been extended to exclusive economic zone, 200 nautical miles from every shore. So we recognize every country as the first 200 nautical miles from the shore is their airspace, land space, whatever you want to call it, right? So what they're doing here is they're saying, well, you got a GPS when you're following the whales. And when the whales are inside of the territorial sea, you're in Canada. And as soon as the whales decide they want to swim, that's it. You can't claim anymore. And that's exactly how they applied it. And this was pre this 10% thing. And yeah, practitioners like us are saying like, oh my God, this is just getting ridiculous. This is silly. They're a physical location test. So again, the client was very offended, saying, you know, we're all Canadian employees, we're in waters where we're not even allowed to be there, we have to phone in, you know, before we do any cat. Like, really, it's clearly in Canada, and yet you're arguing. It was a case, I had a similar case like that on the East Coast. I actually had the Ministry of Fisheries, Brian Tobin, write a letter on behalf of my client to the Minister of Finance saying this is freaking ridiculous. Like, you guys are way off base here, and it caused a lot of interesting changes in part of it actually leading to this 10% thing. But the thing is, that should be 100%. As long as the employee doesn't get what's called OECD, as long as they're still paying tax here, they don't get an overseas employment tax credit, Canada got all the money. Canada got all the benefit. They should pay the tax credits. All right. Getting near the end. Quantetics. So this is an interesting one on what is ASA, or all